All right, we're getting this in, and the president echoed this in an interview a couple of weeks ago, but boy, does he have concerns about the Federal Reserve spoiling this party. The president, according to Bloomberg News, talking about what he mentioned with Republican donors at that Hamptons fundraiser on Friday, that raising interest rates in this environment is really not very constructive. The Federal Reserve, as you know, has raised rates 5 times since the president took office, and the president takes exception to what has happened, that it can nip the progress we're making in the bud here. This echoes similar concerns the president has had about raising interest rates just as the recovery is taking off and thereby jeopardizing that said recovery. All of this, of course, occurs the same week Jerome Powell, the chairman of the Federal Reserve, is going to be on Jackson Hole, Wyoming, talking about the economy, and will probably give his first comments, maybe answer questions about the president's concerns therein, about rate hikes in general. Market watchers Dan Schaefer, David Bahnsen, and our own Susan Lee. Well, Susan, this echoes something he has said many times before, that, you know, and other presidents feel the same way. He has just made it very, very clear how forceful he is about it, that it's a mistake for the Fed to be doing what it's doing. How does that affect the Fed's thinking, I think?
Well, the Federal Reserve is supposed to be an independent policy-making institution, right? But when I spoke to traders across the New York Stock Exchange today and asked about interest rates and how it plays into the mindset, they said, look, we're halfway through the third quarter. We're probably going to grow at 3.5% for GDP. As you know, 3%, if we get anything above 3%, that's the strongest economic growth that we've seen in 13 years. And the subsectors, that tells the whole story. For instance, transports here for the Dow Jones Industrials, we're hitting a record, up 135 points today. That shows you that goods are moving across the country by trucking, by any means, by railroad, and that is an economic proxy and shows you the U.S. economy is growing.
You know, getting a little bit more details from this Bloomberg report I want to share with you, David. The president said he expected Jerome Powell to be a cheap money Fed chairman and lamented to some of these Republican donors at this fundraiser that his nominee instead raised interest rates, so that he was disappointed. This wasn't the guy I thought he was. What do you make of that?
Well, it's unfortunate if that was really said. I mean, obviously, I don't know the sources of this whole Hamptons event, but I don't think it's a big surprise to any of us that the president, who spent most of his life with extraordinary leverage on his own balance sheet, would prefer easy money to sound money. But it's kind of surreal that he sent a tweet over the weekend bragging about the strength of our dollar and then is lamenting the idea of the Fed just trying to get to normalized monetary policy. At the end of the day, I don't believe for a second that he expected that whoever he named head of central bank was just going to take orders from them. The fact of the matter is Powell does have a difficult decision to make near the latter part of this year and into next year. But getting the Fed funds up to a 0% real rate so that net of inflation it's at 0 is hardly them becoming a tight Federal Reserve.
All right, and we're close to, we're at that now. But Dan Schaefer, it does make you wonder about every move now the Federal Reserve makes or Jerome Powell states, because it will be scrutinized under this, this environment where if he doesn't raise rates as aggressively as it planned, I think there are 2 more rate hikes expected this year, at least that many next year, then people are going to say, wait a minute. And conversely, if he does, then the president's right, he's overdoing it. He can't win.
Well, the Fed Reserve is making a big mistake by raising the rates. I agree with President Trump. With the amount of debt that's globally in U.S. dollars to try to service that debt, raising short-term rates is going to be a problem. And we could see that, Neil, in the bond market with the 10-year and the 30-year Treasury yields declining as the Federal Reserve raises the short end, which affects home equity loans. It affects some mortgages that are variable. A 0.25% is a major move. And I think the Fed is raising rates now because they're worried they're going to need to backpedal as the economy starts to slow down. So I really agree with President Trump that the short-term rate should not be raised, and the bond market's telling us that.
Well, I mean, I understand what you're saying about debt levels, and this would make it easier for those debt levels. We've had this debt for a while now. You could have made that argument at any point. We've gotten used to near 0% rates. So, Susan Lee, that's what's got to change. So far, it's been changing in our favor. The world still comes to us, both our fixed income markets, certainly our equity markets.
Yeah.
I wonder if any of this changes that.
That's a good question. At this point, if you look at the price action, I don't think it does, because Goldman Sachs has said, even if we get 2 more interest rate increases, 2 to 3, and it's the tariffs, by the way, that's going to play into the investor mindset and the markets, we should be above 3,000. So there's still a lot of technical play out there. Valuations are not stretched by any means. I mean, take a look at Apple today, hitting another record high, right? And people are expecting it to be a cash machine. So they just started their $100 billion share buyback. And, if stock names like Apple, Amazon, and the FANGs are still, gaining at this point, there isn't fatigue just yet, regardless of what the Fed does.
Do you buy that, David, that the environment is sound, the president should just be quiet?
Well, I think the environment is sound, and I do think it's wholly inappropriate for him to be intervening at all, not the least of which is because it undermines exactly what you said, the credibility when they do end up acting. But as far as the comment that they shouldn't be raising the short-term rates, that very well may be true. The point is that Powell and the Fed governors have to make that decision. What the president should be upset about is the Bernanke and Yellen Fed that didn't start this process in 2013 and 2014. That's why we're dealing with this now. That's why they're having to raise short-term rates in the face of emerging market complexity now, because they're so behind the 8 ball. It's a tangled web they weave when they first practice to intervene. That's what has happened.
All right, guys, thank you all very, very much.